Hi there, welcome to Kneppy Invest, and welcome to another Kneppy's Stock of the Day on a hot and humid Brisbane afternoon. I am sweating like a hog. I did spend a little bit of time outside in the past hour doing some chores, and I am feeling it right now. Anyway, I decided to record this video a little bit after the market has closed because I'm going to choose the company that either performed the best or the worst in trading today. I have no idea what company I will choose to feature in today's video, so it makes recording this video exciting on the one hand, but also daunting on the other because I have no idea what company I'll be talking about. And the reason it could be exciting is because I might be featuring a company I know nothing about. So I could learn a little bit more about a company. Now, I am hoping it might be Aussie Broadband. They actually did have a profit upgrade today. So I'm hoping the market viewed their results and that upgrade favorably. Also on possibilities in terms of share price depreciation, Shine Justice. Had a quick glance at their results and I thought that company share price might drop a little bit. Jumbo Interactive was another company I thought results were pretty good. Austool, thought their results were pretty bad, so wouldn't be surprising to see that company down a fair bit. So I'm going to be using Market Index. They have two stock scans, which is top gainers and top losers. And what I'll be doing is ranking or looking at these companies by a percentage change. You could also, we'll have a look at top losers first. You could also use market cap. And typically at the end of trading each day, I will look at or rank these companies by market cap, not by percentage change. For instance, the best or the worst performing company on the AHX today was Berry Gold, KNB, who saw the share price drop 25.9%. Pretty small turnover, and the market cap of the company is 2.4 million. I don't think that company released their results, and if they did, I don't think it did. Let's just open it up for sure. Now, I've got some rules in place right now, so I want to choose a company that at least has revenue, preferably a company that is profitable. Okay, so let's go down this list. American Rare Earths, I'm pretty sure that company's share price has been quite volatile. Pretty sure this company did a capital raising. Let me just confirm that. Yeah, capital raising. That's probably why the share price is down a fair bit. Okay, Soco Corporation did release results, down 20%. I don't know much about this company. Market cap 19.4 million. Fairly low turnover, 76,550. So it's either between Soco Corporation and the next company down, Shine Justice. So not surprising to see Shine Justice as the fifth worst performing company, down 18.4%. I'm going to probably choose Shine Justice at this point in time, although maybe I should do Soco Corporation because I have no idea what that company does, and that could be an exciting move. Exciting video. Oh, shocked. I am shocked to see Duratec on here. 16 down 16%. Their results I thought were pretty good. I am a share of that company. I don't know why the share price of Duratec is down 16%. That is shocking. So obviously I missed something in results, but on the surface, their results look pretty good. Laser Bond, not shocked that share price of that company is down 13.8%. Let's have a look by market cap. Austal's there, down 12%. Not surprising there. Okay, so at this point in time, Shine Justice, or maybe Soco. Okay, what was Soco? That was down 20%. Okay, 20%. So let's have a look at the top gaining companies. Whitehawk, up 100%. They did not release their results. I'm pretty certain. I did not see it. Might have missed it, but I did not see it. Oh, response to ASX price query. They released nothing today. It was just stupidity, market stupidity that saw their share price rally 100%. Archer Materials, no. Turnover 2 million. Pharmex, I do remember seeing this company release their results, up 30%, but a really low turnover. So that's probably another filter I'm going to use is turnover. That's a really small, $10,000 worth of shares traded today. It's probably too small. Market cap 23.3 million. I'll just write that down. I could be doing Pharmex a disservice by not choosing them in today's video, but up 30%. And okay, we have a winner. AHX, Apiam Animal Health, up 25.4%. I do remember opening up their results and thinking, oh, not bad. Maybe not 25.4% higher, bad, good. Did I say bad? No. These results are pretty good, but maybe not 25.4% higher, pretty good. I'm looking for Aussie Broadband. Oh, there we are, up 18.6%. Oh, so close. Actually, it's not really so close because APM was up 25.4%. Now, to be honest with you, I probably should be doing this video on Aussie Broadband because their results were pretty good. but it was just they also issued an upgrade, and the market loves upgrades. So today's video, I'm going to be featuring Apiam Animal Health. I'm pretty sure I have not done a standalone video on this company. I might have mentioned this company once or twice in other videos. Not the sort of company I like. It says here healthcare, but you can tell by Apiam, or the name of this company, Apiam Animal Health, this is into animal health. So we're talking about vet clinics, and I'm pretty sure the majority of their business, if not all their business, all their revenue is generated through vet clinics. Now, straight away, the first thing I'm going to say is I'm not the biggest fan of vet clinics. So AHX, not AHX. I'm not the biggest fan of this type of company. When I say this type of company, I'm talking about where the major or the talent is in people. So these sort of companies, when talking about veterinarian clinics, law companies, accounting companies, those sort of things, the talent is the labor. Those professionals, they're the talent. And you have to pay a pretty penny to keep those talent in the company. And that means labor expenses for these companies can be quite high. And to be honest with you, I prefer labor light companies for a few reasons. So I'm not going to talk about that in this video because I want to focus on Apiam Animal Health. So the first thing I'm going to do is look at the half-year report and accounts. Might have a look at the announcement, maybe not the presentation. I'll leave that for another day. So the things I'm looking for here, I'll go through the statements. I go through all three statements, and I'm just looking for numbers. Looking at numbers, and then I'll go through the media release. And what I'll be doing in the media release is looking for any sort of upgrade. So I did not go through the media release when I first saw this company's results. But one of the reasons why, or possibilities why the share price has rallied today is because the company also issued an upgrade. And that would be understandable because, again, the market loves upgrades. So Apiam Animal Health. Now, if this was a full year results, typically what they do have at the beginning of the results is what the company does. The other thing I should mention, this company is profitable and they're going back to giving their shareholders a dividend. So they paused their dividend program. Now they're going back to dividends based off this. So 2023 final dividend was 0 cents. Now there's an interim dividend. So I do remember that. And that's another possible reason why the share price has rallied today, because they're going back to their dividend, paying dividends back to the shareholders. And the market loves that. Australians love dividend paying companies. Okay, net tangible assets per share, negative 27 cents. Okay, we'll talk about why. I'm pretty sure that's intangible assets. Okay, principal activities. So if you don't know what a company does, you can just look at this, or many announcements released by companies, they'll have it at the bottom of the announcement about Apiam Animal Health, and they'll talk about what they do in a little bit more detail than this. So Apiam Animal Health and subsidiaries' principal activities include the provision of veterinary products and services for production and companion animals. So production is an interesting term there. Anyway, so the first thing I want to do is look at the profit and loss statement, which is right here, hopefully. Yep, there it is. Okay, so what I'm looking for here is revenue. Actually, before I look at this, I should, no. I was going to look at the highlights first. In the highlights section, they go revenue, profits, and maybe some of the stuff as well. Actually, let's just see what they did say in their highlights section, which is right here. Here we go. So revenue up 11%, profit up 13% to 3.3 million, and underlying EBITDA up 33% to 9.2 million. So notice there's a big difference between underlying EBITDA and profit, and that's because this company probably has high interest payments and maybe high amortization, because this company is acquisitive. They do make quite a few acquisitions for vet clinics, and that's another reason I don't like these sort of companies, because one of the ways they grow is through acquisitions. Just think G8 Education, company that is into childcare. They went through this acquisitive stage about 8 years ago, and the market loved it, and then it just stopped. And look at the chart for that company, and it's done nothing over the past 6 or 7 years. So there's another reason why I'm not a big fan of these companies, because the way they grow is through acquisitions. But nice growth in revenue, profit, and underlying EBITDA. So let's have a look at the, I'm going to open this up. Let's have a look at the Profit and loss statement. So we already know revenue's up to 104 million. Not surprising here that the biggest cost is employee benefit expenses, 46.6 million. Again, they have to pay the vets to treat the animals. It is their talent. It is their major reason this company is in existence because of their veterinarians. If they piss off the veterinarians and they go somewhere else, that will be bad for this business. Cost materials, 35.3 million. Not surprising because for the veterinarians to do their job, they need materials. They need stuff to fix the animals. So together, cost of materials and employee benefit expenses, about $82 million of 104 million compared to revenue, 104 million. So not high. They can't have high expenses elsewhere because of cost materials and employee benefit expenses. And again, profit 3.3 million. Earnings per share 1.84 cents. Current share price of this company, what was it? 39 cents. Wow, so interesting here. So earnings per share about 1.8 cents. This is for a half year. If they have a similar result for the full year, means earnings per share will be about 3.6 cents, which means this company, if you look at PE ratio, will be trading on a PE ratio of just above 10. So about 12 or so. No, about 11 or so, which you could argue that is fairly cheap. But that does not include debt. I prefer to look at enterprise value when I'm looking at potential valuation or whether a company is good value or bad value. You have to also include debt and cash. So let's have a look at the balance sheet. On the balance sheet, the balance sheet, And why do they call it balance? Because net assets must equal total equity. Net assets must, which is 121.353 million, must equal equity, which is 121.35 million. I'm not an accountant, but that's one thing I do know. Balance sheet. Net assets must equal total equity. Anyway, so when I'm looking at the balance sheet, some things I'm looking for here are cash, fairly low cash, trade and other receivables, and trade and other payables. So we're looking at, and inventories. So we're looking at changes in working capital there. This company does have a fair bit of inventories, which makes sense again, because again, the vets to do the job need a fair bit of inventories. They need drugs and all that sort of thing. So $17.4 million of inventories is a significant increase or decrease in trade payables or trade receivables. No big, slight increase in both of them. So there is a slight change in working capital, but nothing too big. The other thing I look at here is intangible assets, which is 168.7 million. So again, the net tangible assets of this company was negative. Remember that. And the main reason it's negative is because intangible assets are quite high at 168.7 million. And one of the reasons why intangible assets might be quite high is because, again, this company is quite acquisitive. So when they buy, possibly even overpay for another vet clinic, some of that goes to intangible assets. And one way this company will be massively loss-making in future years, if they have a bad year, is when they write down some of their assets, and that intangible assets line will go down, say, $30 or $40 million in 1 year. That's how sometimes a company can have massive losses because of write down intangible assets. So intangible assets are quite high. In fact, tangible assets are greater than the equity of this company. That actually is a little bit of concern for me. The other thing I like to look at when I'm viewing the balance sheet is loans. This company, no loans in current liabilities. So I'm just looking at borrowings here. Non-current liabilities, borrowings of 70.3 million. I think one of the ways this company has acquired a few vet clinics is just by borrowing money. That is a little bit of concern for me, $70.3 million of loans, which means this company has a markup. I think, if I remember correctly, this company had a markup of about $70 million, according to TradingView. Let's have a look again. Was it 60 million? In fact, if I open it up, APM in marketing, it will give me the markup. $71 million, 180 million shares. Okay, so this company has a markup of $71 million. Now, one of the reasons I'm not a big fan of PE ratio is because it does include cash or debt. I prefer to look at enterprise value, which includes cash and debt. So the enterprise value of this company is about $140 million. What was the debt again? Borrowing 70. Yeah. So the markup of this company is almost identical to the borrowing. So this company has an enterprise value of $140 million. So that means, remember when I said the PE ratio of this company is about 11? You could say that the true valuation of this company, if you're looking at a different evaluation metric, say EV to EBITDA or EV to EBIT, or instead of price to earnings, you look at enterprise value to earnings. This company has a much higher valuation metric number, so maybe not quite as cheap just because of those borrowings. And again, total equity 121.4 million, which is lower than the company's intangible assets. So a few red flags in my opinion. And the main red flag is borrowings. That is a high amount of debt to service. We can look at note 10, if I remember, just to see how much they are paying interest in. In fact, we could actually see how much they're paying interest, maybe in the cash flows from operating activities. Oh, interest paid only 2.6 million, so not that high. I thought it might have been higher, but up from 1.5 million in 2022. So in the cash flow statement, the main thing I'm looking for is cash flow from operating activities, and then also look at capital expenditure, which is payment for property, plant, equipment, and then we get a free cash flow. No significant changes in working capital, so that's a good thing. So I don't have to really take that into account here. But cash flow from operating activities, 8.2 million, slightly higher than last year, which was 7.4 million. And capital expenditure 2.1 million. So this company was free cash flow positive by $6 million in one half. So they could be operating or free cash flow positive by about $12 million in a year, which will be quite a bit higher than the company's profit more than likely. So if you do use a valuation metric that encompasses or uses free cash flow, you might get a much better valuation, or a number that might be screaming out, this company is pretty good value. Other things I'm looking for here is payment for acquisitions. They spent a lot of money in the last 2 years on acquisitions, about $28 million for vet clinics, no doubt. No dividends. Does that dividend received 50 cents or $50 or $50,000? And does look like the loans borrowings actually increased. Notes. Sometimes I look at notes just to get a disaggregation of revenue. You usually see that fairly the first few notes, but I have no idea what this is. During the reporting period, the group acquired 100% of the business assets of Boyne Tunham Vet Surgery and acquired 100% of the issued capital and voting rights of Macleay Valley Veterinary Services. So this company is acquiring other companies or other vet clinics. So I'm assuming this company only derives or gets their revenue from vet clinics. That's what I'm thinking right now, because I'm not seeing anything else here. Probably plant equipment, earnings per share, share capital. You could have a look at all this. Borrowing, here we go. Borrowings, banking covenants. You go through that if you really, really want to. Here, this is what I'm looking for. The interest, well, they don't have interest rates here. So if you look at Appendix 4C or 5B, if you go to Section 8 of those announcements, they actually will have what the particulars of the facilities are in terms of interest rates, how long they are there for. Okay, so that's all I'm going to look at in terms of the financial statements for Apiam Animal Health. Now let's go to the media release. And the thing I'm looking for in the media release is any sort of outlook. So I don't care about all these bullet points. They're going to be positive more than likely. Although if you do see anything negative, that actually is fairly important. This is interesting bullet point here. While acquisitions continue to be a strategic focus, no further acquisitions are expected to be completed in financial year 24. Strong cash flow generation to be applied to organic growth initiatives. So one of the reasons why I don't like these sort of companies, again, I don't think they grow much through or by organic ways. They grow through acquisition. So it's really interesting that they've used organic growth initiatives in one of these bullet points. So possibly the management does want to utilize all the assets they have right now. But to be honest with you, how is this sort of company going to grow organically? Because they can't say to the vets, you have to work harder. That's definitely not the way forward, because that could be detrimental to this company in the long run. Because if a vet is working harder, they're actually more likely to make mistakes. And if they make mistakes and someone's loved pet dies because of a veterinary's mistake, they're going to go to another veterinary clinic. So how are they going to grow organically? By cross-selling products, that sort of thing? I have no idea. That's another reason why I don't like these sort of companies, because the way to increase productivity, it's actually really hard, because they have a reliance on labor, reliance on people. Okay, on a bit of a tangent there. Don't have to go through those numbers. I'm looking for an outlook here. And as I mentioned before, if you don't really know what a company does, just go to announcement. And here it is. It's got it for you what this company does. About, and this is a little bit more detail than what we saw in the financial statements. One of Australia's leading rural veterinary businesses. So it does seem like this company relies on production animals, as they said, I think, somewhere. Production animals. So I think it's production and companion animals, I think. Did they say production here? Yeah, here it is, production animal. Anyway, oh yeah, so what I'm looking for here is any sort of outlook. Here it is, the outlook. Oh yeah, is this the reason why the market got excited? And this is an outlook without any substance. It's an empty outlook because there's no numbers. I want numbers. Let's see if there's any strong language here. When I say strong language, I don't mean swearing. I mean bullishness. You can actually get excited by the language that is in any sort of commentary, and you can just see that, oh, this company's management is quite bullish, or they are bearish. Okay, so revenue opportunities for Apiam remain strong as demand for non-discretionary veterinary services are supported by the essential nature of animal healthcare the company provides. Okay, you can say that's okay. The primary focus for financial year 24 is to extract further earnings and cash flows from the existing clinic portfolio while at the same time maximizing organic revenue growth across the business. So I do have questions about that. What are they going to do to get all this organic growth and extract further earnings? APM is expected to generate strong cash flows in financial year 24, and these are to be applied to organic growth initiatives. What are these organic growth initiatives? I should look a little bit deeper into this company. Effective debt management. What are they going to do? And with that, and the resumption of APM's dividend program. Would a better debt management program not to pay dividends instead of using dividend money to repay the debt? So that is a question I have. Is this a good allocation of the company's capital? Hey, let's ponder those questions after I finish recording this video. And that's probably, actually, let's have a look at the chart first. Company is to go. Okay, a nice looking chart. Let's zoom out. And let's look at the weekly chart first. Let's have a longer time frame. It's not updating. Okay, so when it doesn't do this, you must auto fit. There we go, it's auto fit. Sometimes it does that, training you. Okay, so this is the weekly chart, and the share price has bounced off the all-time low. In fact, this chart, the weekly chart, does not look good. Up a little bit, then down. Up a little bit, then down. Share price as high as about $1.87. Back in 2016, this company's been around for a long time, and the share price is just bouncing off a low. But if you do look at the daily chart, possible play here. Oh, the one thing I'm looking for here is volume. Yeah. So I probably would prefer a little bit higher volume, but the share price did close or did finish at nearly at the high of the day. So a little bit of excitement in the market, share price possibly moving into an uptrend, but the share price not at a 6-month high. Last time the share price was this high was back in September, so about a five-month high for APM. Now, sometimes I'm willing to look past that 6-month high rule, and maybe this would be a case, but I probably would prefer a little bit more volume when it comes to this company. So some red flags for this company, particularly the debt. I'm not sure about the capital allocation decisions. So paying a dividend when they have the debt, I'm not sure about that. That is a big question when I would have to the company's management if I was talking to the management, which I don't think they would want to talk to me. Anyway, so that's all I got for this video, looking at Apiam Animal Health. I don't think this is a high quality company, definitely not there yet. Has the potential to become a high quality company? Probably not, because of what they do. They are reliant on veterinarians, and veterinarians cost a pretty penny to keep. And you can't really get more production out of them, productivity, because if you do that, you tell the veterinarians to work harder. More than likely, you are going to fatigue them. And a fatigued veterinarian is probably not a good veterinarian. That's just my opinion. Anyway, so that's all I got for this video, looking at this company. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.